The word wealth conjures images of glittering yachts and towering skyscrapers. It speaks of flashing logos and extravagant displays. We are conditioned to see it, to aspire to the visible markers of immense fortune. This is the great illusion. True wealth, the kind that endures and dictates global power, is rarely on public display. It is the iceberg beneath the waterline. It is a form of quiet, calculated power that thrives in the shadows, protected by discretion and complexity. Our journey begins by challenging the very definition we have been sold. We must look beyond the spectacle. Consider the man who drives an older, reliable car, who lives in a modest, yet comfortable home. He is financially free. His assets are liquid, diversified, and unseen. Contrast him with the individual who has leveraged everything to acquire the trappings of instant success, the luxury lease, the oversized mansion with crippling debt. One possesses wealth, the other possesses liabilities disguised as status. This documentary is an investigation into that invisible ledger. We are peeling back the layers of consumer culture and media projection to find the bedrock of financial security. It is about the power of compound interest working silently for decades. It is about the strategic avoidance of lifestyle creep. It is about the subtle art of financial independence achieved not through a lottery win, but through disciplined, often boring, decision-making. We will examine historical figures and modern titans who mastered this concept, operating under a veil of financial anonymity. Their true balance sheets are guarded secrets, their success measured not by what they bought yesterday, but by the options they preserved for tomorrow. The hook is simple: what you think you know about wealth is wrong, and the real secret to enduring prosperity is hiding in plain sight, waiting for those who choose to see past the noise. We begin our search for the hidden empire of true financial mastery. Our exploration requires a shift in perspective, moving from the theater of consumption to the silent mechanics of asset growth. The stage is set across three distinct environments: the discreet family office in a nondescript building, the digital ledgers of global investment funds, and the psychological landscape of the genuinely wealthy. These are the arenas where wealth is truly accumulated and protected. We will focus on two key subjects whose stories illustrate this dichotomy. First, Elias Thorne, the archetype of visible excess. He built a media empire that fed the public's appetite for luxury, constantly showcasing his jets, his parties, and his aggressive acquisitions. He is the image we are taught to pursue. He is a spectacle, yet dangerously brittle. His empire is a house of cards built on debt and public perception. Second, we introduce Amara Khan, a venture capitalist and philanthropist whose name is virtually unknown outside of specific financial circles. Her firm manages an extraordinary portfolio of diversified, long-term assets. She drives a standard sedan, lives well below her means, and her net worth is an order of magnitude greater than Thorne's. She embodies the philosophy: wealth is not about spending, it's about not having to spend. She represents the quiet, compounding power of unseen capital. The supporting cast includes financial historians, forensic accountants, and behavioral economists who can articulate the mechanisms at play. They will explain how the tax code favors unspent capital, how diversification becomes a shield against instability, and how the media inadvertently promotes the fragile myth of instant wealth. They will guide us through the jargon, revealing that the simplest financial truths are often the hardest to accept. We are moving beyond the noise of the stock market ticker tape and into the deep strategy of intergenerational stability. The central conflict will be between the loud, fleeting nature of Thorne's brand of riches and the robust, enduring quietude of Khan's financial fortress. The core mystery of "wealth is what you don't see" lies in the recurring collapse of seemingly impregnable fortunes. How does a billionaire, frequently featured on magazine covers, suddenly find himself filing for bankruptcy? The problem is the public's inability to differentiate between net worth, what you own minus what you owe, and cash flow, the money moving in and out. The public sees an asset, but they fail to see the corresponding liability. Our initial problem is framed by the sudden, dramatic unraveling of an institution, let's call it the Helios Group, a high-profile, luxury real estate firm founded by a figure much like Elias Thorne. The Helios Group owned visible, iconic properties. It sponsored major sporting events. Its founder lived a life of highly publicized opulence. Yet, a financial tremor, a minor dip in the market, causes the entire structure to crumble. The mystery is why this visible firm was so vulnerable, while a competing, almost unknown entity, Aegis Holdings, covertly linked to Amara Khan, not only survived the downturn but thrived. The visible problem is the collapse, the hidden mystery is the structural difference between the two companies. Helios was a leverage machine, every asset a borrowing device, every purchase a desperate bid for status. Aegis, conversely, held minimal debt, favored assets that generated quiet, recurring income, and avoided any investments that required public validation. Forensic examination of the Helios Group's demise reveals a pattern of financial distress signals ignored because of the founder's celebrity. The public perception of endless wealth was the ultimate camouflage for deep insolvency. This is our opening investigation. We will use the Helios case as a lens to understand the psychological trap of equating spending with success, setting the stage for our deep dive into the true, unseen power of Amara Khan's approach. We must determine what truly constitutes a financial shield, and why the most spectacular empires often have the weakest foundations. The crucial discovery comes not from analyzing balance sheets, but from examining tax filings and the geographic distribution of assets. The first major clue is the concept of a stealth portfolio. While Elias Thorne's entire portfolio could be mapped by cross-referencing public records of property ownership and SEC filings related to his publicly traded media arm, Amara Khan's financial footprint is virtually untraceable through conventional means. The discovery centers on a small, decades-old, private investment fund tucked away in the structure of Khan's overall holdings. This fund is not a hedge fund seeking quick returns, it is a capital preservation engine. The clue, an analysis of its underlying assets, reveals a long-term, buy-and-hold strategy focused on necessities and non-cyclical industries, agricultural land, vital infrastructure, and private equity in utility companies. These are assets that do not make headlines but consistently generate income. The crucial discovery is the lack of churn. Thorne's companies trade constantly, generating taxable events and paying large fees to brokers and banks. Khan's fund is designed for minimal transaction activity. Her true wealth is not the value of the assets, but the fact that those assets are held for so long that the tax on the capital gains has been perpetually deferred. The sheer magnitude of this untaxed, compounding growth, invisible to the average person, is staggering. Her wealth is growing geometrically, while Thorne's is growing arithmetically and constantly taxed. This revelation forces us to redefine financial news. The exciting, visible news is the IPO, the acquisition, the quarterly earnings beat. The real power is the quiet, decades-long growth of an asset that simply sits there, generating income and deferring taxation. The true measure of her financial health is not the price-to-earnings ratio but the duration of ownership. This is the moment the audience understands that the game is not about how much you make, but how much you keep, and for how long. The quiet holdings are the key to the empire. To understand why Amara Khan operates in such a discreet manner, we must delve into the historical and contextual origins of her approach. Her philosophy is not a modern invention, it is a direct inheritance from the great, enduring fortunes of history, the Rockefellers, the Rothschilds, and the European noble families. The context is simple: durability over display. Khan's family wealth originated not in a disruptive tech boom, but in the stable, unglamorous world of commodity logistics and infrastructure a century ago. This foundation instilled a fundamental respect for cash flow over valuation. The deep dive reveals that after initial success, the family implemented a strict, 3 generations rule: no more than 10% of the principal capital could ever be liquid or used for status spending. The remaining 90% was locked into the stealth portfolio designed solely for preservation and quiet growth. The context is also cultural. The ethos was one of financial monasticism, where public display was considered a liability. It attracted attention from competitors, regulators, and fraudsters. This stands in stark contrast to the modern culture of immediate gratification and social media-driven validation that defines Elias Thorne's origin. Thorne's story is one of rapid leverage, media savvy, and a belief that fame and fortune are interchangeable. He needed the spotlight to attract more debt and more public capital. Khan's ancestors taught her that the most dangerous phase for any fortune is the second generation, often characterized by the sudden ability to spend vast, unearned sums. Their counter-strategy was to keep the true scale of the wealth invisible, making the family feel comfortably well off, rather than indescribably rich. This psychological framing is the origin of the invisibility. It fosters a discipline where money is seen as a tool for leverage and option value, not a passport to excessive spending. The goal was not personal satisfaction but the perpetuity of the capital itself. This historical context explains why Khan views a high-profile asset like a private jet as a multi-million-dollar liability that depreciates and demands attention, while Thorne sees it as a necessary prop for his narrative. The investigation now reaches a point of ideological conflict, pitting the traditional, durable wealth theory against the modern, leveraged growth theory. The stakes escalate as we analyze current market conditions. Theory A, the durable wealth model, Khan's, argues that maximum growth is achieved by minimizing friction, specifically taxes, fees, and emotional decision-making. Its proponents, our financial historians, assert that true wealth is measured by time, not immediate market gains. The theory is that a predictable 7% return over 50 years, compounded and untaxed, will fundamentally outperform a volatile 20% return over 5 years that is then heavily taxed, spent on a luxury lifestyle, and subject to 50% downside risk. The core tenet is that the avoidance of loss is more important than the pursuit of massive gain. Theory B, the leveraged growth model, Thorne's, argues that in a modern, hyper-competitive economy, leverage and visibility are assets. Its proponents, younger financial commentators and disruptive tech investors, claim that debt is a tool to amplify returns, and that public visibility is essential for attracting the next round of capital. They argue that not maximizing leverage is a failure to fully utilize assets, and that keeping a low profile is simply leaving money on the table. They prioritize high rate of return over rate of preservation. The escalating stakes are demonstrated by introducing a new, market-wide economic stress test, a sudden, unexpected geopolitical crisis that causes a sharp correction. This event acts as a live experiment. Thorne's highly leveraged, publicly visible holdings are immediately vulnerable. His debts are called, his assets are suddenly illiquid, and the media spotlight becomes a high-wattage lamp exposing his frail structure. Khan's stealth portfolio, primarily invested in recession-resistant infrastructure and holding large, unencumbered cash reserves, the true invisibility, is not just protected, it can now acquire Thorne's distressed assets at fire sale prices. The conflict is no longer theoretical, it is playing out in real time, showing that visibility attracts risk, while invisibility attracts opportunity during a crisis. The stakes are the survival of one financial ideology over the other. The economic stress test introduced in the last section forces Elias Thorne to the point of no return. The illusion of his wealth can no longer be maintained. He is forced to liquidate core, profitable parts of his media empire to service the massive, hidden debts tied to his luxury lifestyle and his over-leveraged real estate holdings. This liquidation is a public, humiliating spectacle, confirming the public's sudden realization that his assets were never truly his own. The point of no return for Thorne is the moment he sells the iconic, Sentinel Tower, the glittering, visible headquarters of his empire. This sale is not strategic, it is a desperate attempt to cover margin calls. The buyer, quietly executing the transaction through a labyrinth of shell companies, is revealed to be Aegis Holdings, Amara Khan's capital preservation engine. For Amara Khan, the point of no return is a strategic, calculated pivot. Until this crisis, her wealth was focused entirely on preservation. Now, with Thorne's distress, she activates a massive, pre-planned liquidity event from her truly unseen cash reserves. This action signals her willingness to move from a purely defensive position to an offensive one, leveraging the financial stability she cultivated for decades to reshape an entire industry. She is not buying the asset for its status, she is buying it for its cash flow potential and its distressed valuation. The narrative crosses a threshold here. The investigation moves from simply analyzing financial philosophy to documenting the transfer of power. Thorne's public downfall is Khan's private, highly profitable moment of truth. She doesn't need to be seen to win. Her victory is defined by her ability to transact while everyone else is panicking. The silence of her acquisition contrasts starkly with the cacophony of Thorne's collapse. This moment fundamentally breaks the narrative that, you have to spend money to make money or, you have to be famous to be powerful. True financial power, we see, operates on its own timeline, emerging only when the price is right and the spotlight is elsewhere. The midpoint twist is the realization that the greatest hidden wealth is not money, but time. The halfway revelation for the audience is this: Elias Thorne's true poverty was not a lack of assets, but a deficit of future options. He had mortgaged his future to finance his present spectacle. Every dollar he owned was tied up, and every day was a race against a deadline, the next debt payment. He had zero financial optionality. His spending had created a high-stakes, stressful, and ultimately fragile existence. The twist regarding Amara Khan is that her decades of disciplined invisibility have created an almost infinite amount of optionality. The 200 words her investment strategy adds to this section reveals she does not need to buy Thorne's tower. She does it because the return on capital is irresistible, but her life remains fundamentally unchanged whether she makes the purchase or not. She can choose to work, travel, retire, or invest on her own terms. Her true, unseen wealth is the freedom from urgency. This freedom is the most valuable, non-monetary asset in her portfolio. We use behavioral economists to explain this. They frame it as the difference between a finite game, Thorne's, which has a winner/loser and an end, and an infinite game, Khan's, where the goal is simply to keep playing. The twist reframes the entire documentary. It's not just about money, but about the quality of life and the reduction of stress that financial invisibility grants. The ultimate luxury is not a yacht, but the ability to choose what you do every day for the rest of your life. The twist pivots the theme from how to get rich to how to stay rich and free. This makes the pursuit of invisible wealth a profoundly human goal, not just a financial one. New evidence surfaces that dramatically underlines the psychological impact of visible versus invisible wealth. This evidence comes from internal documents and personal testimonies. The first piece of evidence is a series of leaked emails from Thorne's personal assistant detailing the relentless pressure, the constant chasing of payment deadlines, and the sheer volume of time spent managing his public image and his luxury lifestyle. The psychological impact on Thorne was severe: chronic stress, isolation, and a life spent in a reactive state, always fighting to keep the illusion alive. His visible wealth was an emotional and mental drain, a gilded cage he could not escape. The evidence paints a picture of a man who was wealthy in title but desperately poor in spirit. The second piece of evidence is a rare, anonymous interview with a longtime associate of Amara Khan. The associate describes Khan's life as characterized by profound calm and strategic patience. The psychological impact of her invisible wealth is a sense of unshakable security. Because she avoids public attention and high-debt acquisitions, her mental energy is freed up for philanthropy and high-level strategy, rather than fighting fires. She possesses cognitive optionality. Her wealth acts as a protective shield, allowing her to make rational, long-term decisions without the emotional bias created by public scrutiny or imminent financial doom. The contrast is stark. The public billionaire was a slave to his public image and his debt. The private multi-billionaire is the master of her time and her emotional state. This new evidence confirms that wealth is what you don't see applies equally to the balance sheet and the soul. The true cost of visible wealth is psychological, demanding a constant performance that ultimately erodes the very freedom money is supposed to provide. Her anonymity is her most powerful form of self-preservation and mental stability. The forces that rely on the visible wealth narrative will actively attempt to suppress the truth that Amara Khan's model is superior. These forces are primarily the financial media, the luxury marketing industries, and the system of leveraged lending. We explore how the financial media, reliant on spectacle and celebrity, finds Khan's story unmarketable. Her discipline, her lack of debt, and her long-term strategy do not generate clickbait or high-frequency trading fees. They have a vested interest in promoting the volatile, short-term success stories like Thorne's because it encourages more high-volume trading and consumption. The suppression is subtle, it's an omission rather than a direct attack. They simply do not cover her, making her financially invisible to the masses. The luxury industries, real estate agents, auction houses, and fashion brands, also suppress the truth. Their entire business model is predicated on the belief that the wealthy must externalize their success through purchases. They must perpetuate the idea that high spending is mandatory for high status. Their attempts to lure Khan into visible consumption have failed for decades, making her a quiet threat to their narrative. They prefer the customer whose identity is tied up in their purchases. The most powerful suppression comes from the leveraged lending system. They need borrowers like Thorne, who take on massive, high-interest debt to fuel their visible lifestyles. Khan's no-debt, high-cash strategy is the antithesis of their profitability. Our documentary reveals how major financial institutions prioritize Thorne's high-risk, high-fee business over Khan's boring, low-fee, highly stable accounts. The suppression, in this context, is a systemic bias toward leverage. This section exposes the entire ecosystem that profits from the illusion of visible wealth, showing how it subconsciously conditions the public to choose debt over discipline. The investigation culminates in a controlled pursuit and confrontation that clarifies the entire thematic conflict. The pursuit is not a physical chase, but a strategic comparison of the two subjects' responses to the same high-pressure situation. We put both subjects under an identical, hypothetical scenario: a sudden opportunity to acquire a critical, undervalued national resource, an asset that requires immense capital and absolute secrecy. Thorne, despite his recent collapse, is theoretically still connected. Our documentary shows his response in the past would have been a desperate, public scramble for capital, calling media contacts, issuing new, high-yield debt, and leveraging his last few assets. His pursuit is loud, frantic, and ultimately self-defeating due to his lack of liquidity and his damaged reputation. His confrontation with the opportunity is one of weakness. Khan's pursuit is the final, compelling evidence of her philosophy. She does not chase, she simply acts. Her response is a single, discreet phone call to her private investment counsel. Her confrontation with the opportunity is one of quiet, decisive strength. She utilizes the large, unencumbered cash reserve she has maintained for decades, the unseen wealth. She does not need to appeal to the public or to external banks. She has the internal capital to close the deal immediately and silently. The confrontation reveals that in the highest levels of global finance, secrecy and speed of execution are the ultimate competitive advantages. Thorne's visible success made him slow, burdened by public opinion and debt covenants. Khan's invisibility made her agile, allowing her to strike before the market even registered the opportunity. This segment proves that the most powerful form of wealth is the ability to move without permission. The final pieces of the puzzle concerning the true nature of wealth are assembled by connecting the disparate concepts we have explored: deferred tax, optionality, cash flow, and emotional freedom. The first piece is the concept of the tax-optimized life. We show a comparative financial model, Thorne's high income, high spending life resulted in paying 40 to 50% of his earnings to taxes and fees. Khan's low income, from deferred capital gains, low spending life means her true growth is essentially tax-free, multiplying her effective rate of return. The government is not her partner, it is her silent, future debtor, waiting for a capital gains event that she continually postpones. The second piece is the realization that debt is a form of visible, borrowed wealth. Thorne's life was an exercise in maximizing the perception of wealth through debt, creating a false signal. Khan's life is about minimizing the signal through zero debt, maximizing the reality of wealth. The visual of a large, beautiful house purchased with debt is juxtaposed with a smaller, unencumbered house that costs the same amount but is owned outright. The latter is true wealth, the former is financial tenancy. The third piece is the role of time as the ultimate multiplier. We conclude the time-lapse chart, showing how Khan's quiet, compounding growth inevitably surpasses Thorne's volatile, high-fee, high-tax, leveraged growth. The system rewards patience and invisibility. The final truth is that wealth is not a dollar amount, it is the margin of safety you create between your assets and your liabilities, your income and your expenses, and your public persona and your private reality. The quiet life is the secret weapon. The primary conclusion is delivered as the core thesis of the documentary: wealth is the non-transferable value of financial optionality, freedom, and time, purchased through disciplined avoidance of the visible status game. The truth is that the external markers of success are fundamentally poor indicators of financial health. The true measure of wealth is the number of years you could maintain your current standard of living without working, and without selling any of your core, income-generating assets. By this metric, Amara Khan is exponentially wealthier than Elias Thorne, even before the market crisis. The primary conclusion emphasizes three pillars of invisible wealth. Invisible assets, assets that generate cash flow without public attention, e.g., infrastructure, private agricultural land, annuities. They are boring, necessary, and untaxed until sold. Invisible liabilities, the lack thereof. Zero or minimal personal debt is the foundation of freedom, preventing any outside entity from dictating your decisions. Invisible savings rate, the true power comes from the high percentage of income that is not spent on status signaling. This unspent capital is immediately reinvested, becoming the engine of future compounding. The final revelation is that the pursuit of visible wealth is a trap. It forces compliance with consumerist narratives, introduces unnecessary risk through leverage, and incurs enormous, unavoidable tax burdens. The person who appears rich is often the person who is financially fragile. The person who appears merely comfortable is often the person with the most significant, unshakable wealth. The documentary asserts that anyone, regardless of income level, can adopt the mindset of invisible wealth by prioritizing savings and stability over spending and status. The aftermath for Elias Thorne is total financial and reputational collapse. He becomes a cautionary tale, a spectacular failure whose story reinforces the documentary's central argument. His legacy is a perfect example of what happens when financial decisions are dictated by ego and the need for public validation rather than rational, long-term planning. The media, which built him up, now cannibalizes his story for maximum dramatic effect. The legacy of Amara Khan is quiet, enduring, and ultimately, far more influential. She used the crisis not for personal gain publicity, but to secure assets that further her philanthropic and strategic goals, investing in sustainable energy infrastructure, for example. Her legacy is defined by the stability she brought to a small, vital sector during a crisis. She proves that the greatest leverage one can have is a pristine balance sheet. She continues to operate in the shadows, her power felt through market actions, not press releases. The modern ties connect this philosophy to current trends. We explore how digital anonymity and the rise of decentralized finance could become the new frontier of invisible wealth. The segment interviews younger investors who are adopting the Khan model, prioritizing early retirement, minimalist spending, and non-traditional, non-traceable assets to achieve total financial independence outside the conventional system. The new generation is embracing the idea that the greatest act of rebellion against the consumer economy is to simply refuse to participate in its spending rituals. The documentary concludes that the principles of invisible wealth are timeless and entirely relevant to a modern world obsessed with public display. Concluding summary: Wealth is What You Don't See has traced the journey from the shallow spectacle of debt-fueled status to the deep, silent stability of capital preservation. We have learned that money spent is not wealth, it is a transaction. Wealth is the money unspent, compounding, and strategically shielded from the friction of taxes and public scrutiny. Elias Thorne's visible downfall served as the necessary contrast to Amara Khan's enduring, invisible power. Her life is the proof that true luxury is measured in optionality, not consumption. The most financially successful individuals often look the least successful, precisely because they understand that a low profile is the ultimate form of asset protection. The lingering mystery is a philosophical one. Given the profound superiority of the invisible wealth model, its reduced stress, its greater long-term return, and its inherent freedom, why does the vast majority of society continue to chase the visible illusion? The mystery suggests a deep-seated psychological flaw, a human need for immediate validation that is continually exploited by the systems of commerce and media. The final question posed to the audience is, can you resist the urge to prove your wealth, and instead choose to simply possess it? The pursuit of invisible wealth is ultimately a battle against the ego. Our story ends not with a final financial figure, but with a challenge to the viewer's personal definition of success. The greatest fortune is the one no one can ever see.